Welcome to This Explainer. Okay, so today we're diving into something that's honestly a real game changer. We've got this mathematically optimal sequence for investing your money. It's basically a step-by-step blueprint designed to max out your returns and minimize your risk over your entire life. And the crazy thing is, building massive wealth isn't just about what you invest in, it's actually all about the exact order you do it in.
Right, so it is super easy to fall into this trap. People love throwing money at the stock market, kind of like feeding coins into a slot machine, hoping for a jackpot. But they're doing this while completely ignoring the fact that they might have credit card debt, charging them like 22% interest. It's literally like trying to fill up a bucket that has massive holes in the bottom, and then just standing there wondering why you're not making any progress. Chasing those stock market thrills without a solid foundation? Yeah. Mathematically, that is just a total recipe for disaster.
And you know, this lack of a foundation is way more common than you'd probably think. Just look at this number, $500. According to recent data, the median amount Americans have stashed away for emergencies is just $500. Think about that for a second. That isn't even going to cover a standard car transmission repair, let alone a real medical emergency or a job loss. Yet people with this exact financial profile are constantly asking, hey, should I buy this trendy new stock, or should I jump into crypto?
Okay, so let's dive right into this blueprint and fix that entire mindset. We're going to follow a really logical 6-step roadmap here. The foundation illusion, the psychological safety net, the high-interest debt trap, the free money exception, the tax optimization zone, and finally, the wild west of investing.
All right, step 1, the foundation illusion.
So the core problem we face right out of the gate is just human nature. We desperately want to skip the boring, fundamental stuff and jump straight to the sexy, exciting investments. And hey, it's totally natural to want the thrill of watching your portfolio grow. But jumping straight to investments? It's exactly like buying fancy granite countertops for a house that has a cracked foundation and a leaking roof. The opportunity cost is massive. If you're out there buying trendy ETFs while carrying high-interest debt, that debt is mathematically guaranteed to wipe out any gains you might make in the market. You absolutely have to fix the foundation first.
Which brings us to step 2, the psychological safety net.
This is where we pour the concrete for our financial house. Before you even think about investing a single dollar anywhere else, you have got to establish a robust emergency fund. I know it's not glamorous, but it is absolutely vital. You always hear that traditional advice, right? Save 3 to 6 months of expenses. But let's be real, that can feel incredibly overwhelming. So we're going to break it down into much more manageable milestones. Step 1 is to just scrape together $1,000 as fast as humanly possible. This covers those annoying little everyday curveballs. Then step 2, build that up to 1 full month of living expenses. And finally, step 3 is pushing for 3 full months. Now, if you have a super stable government job, 3 months is probably plenty. But if you're a freelancer in a really volatile industry, you're definitely going to want to push that out to 6 months or even more.
But check this out, because this is why it matters way beyond just the math. There's this absolutely fascinating research from Vanguard showing that having just $2,000 in emergency savings boosts a person's financial well-being score by a massive 21%. It's actually the largest boost linked to any financial factor they measured. It's really not just about the actual dollars. It's about building that psychological safety net. It stops you from panic selling your investments or racking up even more credit card debt when life inevitably throws a wrench in your plans. Moving on to step 3, the high-interest debt trap. Okay, so the concrete is poured. Now we patch the leaks in our financial bucket. We're talking about the financial cancer that is high-interest debt, which generally means anything charging you over 8% annually. Trying to invest while carrying this kind of debt is literally like trying to run a marathon with a backpack full of rocks. You just aren't going to get very far. To destroy it, you need a strategy. Now, the debt snowball method, where you pay off your small balances first, is great for those quick psychological wins. But the mathematically optimal strategy? That's the debt avalanche method. Basically, you pay the bare minimums on absolutely everything. And then you take every single extra dollar you can find and hurl it at the debt with the absolute highest interest rate.
So, think about what this actually means for your net worth. If you have, say, $5,000 in average credit card debt that's charging you 22% interest, paying that off is essentially earning you a guaranteed 22% return on your money. Seriously, try finding an investment in the stock market that guarantees a 22% return. No way. Paying off this high-interest debt actually beats Warren Buffett's long-term average.
All right, on to step 4, the free money exception.
Hold on, because there's actually one specific time you should interrupt that aggressive debt payoff phase. If your employer offers a matching contribution to your retirement plan, you absolutely must contribute enough to get that full match. Yes, even if you still have high interest debt. Why? Because an employer match gives you an immediate, guaranteed 100% return on your investment. I mean, if they match 50 cents on the dollar, that's still a guaranteed 50% return. It is literally free money just sitting on the table, and you cannot afford to leave it there. So you grab the match and then boom, redirect every other extra dollar right back to that high interest debt avalanche.
Which leads us to step 5, the tax optimization zone.
So your toxic debt is gone. You've secured the employer match. Now it's time to insulate the house. Before we even peek at any shiny new investments, we have to aggressively lock down our tax-advantaged accounts to shield our hard-earned money from the IRS. First up is maxing out your individual retirement account, or IRA. And yes, this comes before putting any extra unmatched money into your employer's 401k. The reasons are simple: control and cost. IRAs let you buy low-cost index funds with practically zero fees. On the flip side, a lot of 401k plans trap you in limited mutual funds with 1% to 2% management fees. And let me tell you, those fees will eat into your long-term returns like termites in a wooden house. So for 2025, make sure you max out that $7,000 IRA limit first.
Now, what's really interesting about this is the great debate, traditional versus Roth. And honestly, it all just boils down to predicting your future tax brackets. Traditional IRAs give you a nice tax deduction right now, making them ideal for high earners who expect to drop into a lower tax bracket once they retire. Roth IRAs, however, force you to pay the taxes today, but the magic is everything grows and withdraws completely tax-free later, perfect for younger earners who are probably in their lowest earning years right now. But listen up, because the absolute crown jewel of the tax optimization zone is the Health Savings Account, or HSA. Capping out at $4,300 for an individual or $8,550 for a family in 2025, it is basically the Swiss Army knife of personal finance. It gives you a super rare triple tax advantage. You get a tax deduction when you put the money in, the money grows totally tax-free while it's invested, and then withdrawals for medical expenses are completely tax-free too. It's literally the only account out there that does all three.
Now, you might be wondering, do I really need a whole dedicated medical account? Well, brace yourself for this number. The average retiring couple today is going to spend over $300,000 on healthcare throughout their retirement. Over $250,000. That is a staggering reality. So an HSA isn't just a glorified checking account to pay your copays. If you invest that money and just let it grow, it becomes this ultimate secret vault that can eliminate one of your biggest financial risks in retirement.
And finally, step 6, the Wild West of investing. Okay, so you've maxed your IRA, your HSA, and then you've circled back to max out whatever's left of your 401k. Now you finally get to buy the fancy light fixtures. This is the taxable brokerage account. Ironically, this is where most people mistakenly try to start their wealth-building journey. And starting here is just a massive error. Let's look at why. Say you invest $10,000 a year for 30 years, getting a 7% return. In a tax-advantaged account, you'd end up with about $944,000. But in a taxable account where you're constantly paying taxes on dividends and capital gains along the way, you'd only have about $700,000. That tax drag acts like sand in your shoes, and it's literally robbing you of nearly $250,000. So don't get me wrong, taxable accounts aren't inherently bad. They just have a very specific, proper use case. You use them when you need complete flexibility without any withdrawal age restrictions. They're also great for bridge funding if you want to retire early and need money before you can legally touch your 401k. Or if you're planning an inheritance to take advantage of a step up in basis. But the key takeaway here is that these accounts only serve their true purpose after your entire tax-advantaged financial foundation is fully built.
So what does this all mean for you? It brings us to the ultimate question. Are you going to commit to building a rock-solid financial foundation, or are you just going to try to get lucky and pick the next Tesla? The math here is entirely clear. If you follow this optimal sequence, emergency fund, debt elimination, employer match, IRAs, HSAs, and then finally taxable accounts, you are basically guaranteeing your long-term financial success. So don't rush for the quick thrill. Embrace the blueprint, knock out the boring stuff first, and let the math do the heavy lifting for you. Trust me, your future self will absolutely thank you.